Michael Frazis is here. He is from Frazis Capital Partners in Sydney. Michael, welcome to the program. You're an Australian, you're into the medical and life sciences, and you're an investor. So when you put all of those hats on at once and you look at the vaccine rollout and how it's been going here in Australia, how do you feel?
Look, I'd say it's pretty disappointing from what's been going on in Australia. I don't think I'd be the only person to say that. I'm not just talking about my book. Obviously, we owned Moderna for a while. We're very disappointed there was no order for that. It seems like there was a lot of politics that determined, which vaccines were chosen. Obviously, one of them could have been made in Australia, and that was the one that the direction Australia went in. Now that vaccine is being caught up in Eurozone politics, and the Europeans are somewhat understandably, given their situation, doing their absolute best to keep all vaccines on shore. But it's been a very slow rollout, and I think there seems to be some level of calculation that we should go slower here, see how things are going, in other countries, and then be a few steps behind. And it seems like somebody made that kind of conscious decision at the highest levels probably, and that's kind of set us back now because we're way behind other parts of the world. And this is, it's April. This issue is still ongoing. We still can't travel, and there's still risk, as we saw in Queensland, very recently. There's still risk of major parts of the country being shut down. So I don't think I'm alone in saying it's been pretty disappointing in Australia to see the rollout in this country.
And as an investor, does that then put your investment thesis at risk in some regards, because we could be potentially wasting the leg up that we had here in Australia because of our initial handling of the coronavirus pandemic?
Yeah, the investment implications are tough. I think the biggest one will be when people can start spending real money on overseas travel, and because all that money is kind of being either kept by people or spent on e-commerce. It'll be very interesting to see when people start taking those really expensive holidays, where that spending actually comes from. In terms of kind of like the actual investing in the companies that are doing the vaccine, so Pfizer and AstraZeneca, this is a pretty small part of their business. Moderna, it's a big one. They can sell, they're selling these vaccines for $20, $30, $40, and there's a good chance they sell hundreds of millions or even $1 billion plus of these. So if you do the back of envelope maths on that, they're still going to create an exceptional amount of cash flow. And the longer this thing kind of stretches out, the more likely it is that those numbers are on the upper end rather than lower. But in terms of when things will really shift in markets, I think it's when consumer spending shifts and people can start spending money on travel. So obviously we're still not there yet.
All right, so if we look more broadly, I guess, at investment strategy, Bitcoin and where it's heading right now, it's sort of been in a bit of range-driven over the past couple of weeks. How are you looking at that?
It's an interesting one. Like obviously we don't trade Bitcoin directly, but it's a very relevant asset class today. I think one thing that struck me over the last few weeks is pretty much every professional investor I speak to has a Bitcoin strategy, either has it, owns it themselves, or is thinking about how they can get involved in some way. I think that's a big change from where we were kind of 2017, 2018, where there was a huge speculative consumer interest, but a lot of skepticism professionally. That seems to have reversed, and there's very few ways that you can actually play Bitcoin in the public market. But there's a Coinbase IPO coming out, which will be very closely watched. There's a handful of crypto miners that are listed that have been some of the best performers in the market this year. So we're watching those closely. As to exactly where it goes next, it's hard to say. It's $1 trillion asset. It's about the size of one of the largest US tech companies. So a few months ago, we're saying it's interesting. The crypto complex is only a few $100 billion. That's not even like a top 5 US tech company, let alone a globally significant company. If you think about that, obviously Bitcoin isn't a company. It's not a perfect analogy, but it does give you some kind of sense check. Just that total market cap and how that relates to, say large cap equity in the United States. And in that basis, it's still roughly in line. So you could see, considering the impact it's having, the fact that people are using it all around the world, the fact there are really important use cases, for example, in countries in South America, Asia, Africa, with unstable political climates. If you pull all that together, the valuation actually seems kind of supported, and you could definitely see further upside as well.
Well, there's that, and then there is the Archegos Capital incident that it now looks like it might cost Credit Suisse $5 billion. Risk management clearly being called into question at some of these big banks. But again, from an average investor's perspective, what do we take away from what we're now learning about how big, this leverage was, and how we still don't know the ultimate end point of how big these losses are?
It's a fascinating one. I mean, you could just see Goldman Sachs' decisive behavior in action again when they just liquidated their position before everybody else. It just shows in that particular game, that prime broker game, you cannot hesitate. You really have to be first and move fast and be decisive. In terms of Archegos, I mean, nobody really heard of this fund, but I think everybody will be wondering how a fund could have tens of billions of dollars of exposure. And you think about how hard most of the bankers in Credit Suisse will be working for, maybe investment banking for a $10, $20 million fee, or how much credit analysis will go into giving a $100 million loan. And then you've got, many, many multiples more of that out to one fund using multiple counterparties. So nobody really knows what their actual exposure is. People will think hard about that. And that today in 2021, that really shouldn't be happening. Risk managers should be looking at the gross notional. If they've got that many billions of dollars out where they could take a $5 billion hit, that's not something that should happen. One interesting thing about that is that there was a pretty big growth sell-off. So it looks like what he was doing was basically like 4 or 5 times leave it. I mean, who knows? We'll probably get the real number soon. But, he was long growth and media stocks, and then most likely short the market to kind of make up for that. If he was doing that, then in the last few weeks, growth dropped 25-30% across the board, whether it's software, solar, e-commerce, and markets actually rallied. So it wouldn't have just been him. It would have been anybody that was running long growth, short the market with leverage. That would have also blown up because you just can't manage a 30% swing, 30% differential between your market hedge and stocks. So I do wonder if that's something of a turning point. Often you get these blow-ups at turning points because often it's kind of the market probing their positions, and then their liquidation is actually what pushes things down, to their low points. So maybe we're just being optimistic here, but we're hoping that marks the end of the growth sell-off that we've seen across the board.
Yes, we do hope. Hey, Michael, just before you go, let's go full circle. We're obviously talking about the vaccine rollout in Australia, the concerns there, for how that's going. When you look at the local market, clearly it has underperformed. Are you seeing much upside at this point where we're at right now?
Do you mean the ASX 200, the broader market?
Yes.
Yeah.
Look, it's not something we track closely. You'd think commodities are placed exceptionally well. That's the first thing, which was likely to support the market for years. The stimulus will go into infrastructure, will go into areas that need that base commodity, that drive that base commodity demand. I think that bodes well for our market. The banks are another huge sector. It's pretty clear that those credit worries last year are no longer a concern, and there's been pretty serious growth in house prices and potentially kind of lending as well. So I'd say like those two sectors, it's pretty positive outlook from here. But you're right, that doesn't seem to have ripped in the same way that the United States has. I'm unsure exactly why.
All right, Michael, it's always a pleasure. Thank you for starting this trading week with us, and we look forward to speaking soon.
Thanks so much. Really appreciate it.